This is Ray Dunlap with Dunlap & Associates Wealth Management in Peachtree City, Georgia. And this is the latest in our series of videos designed to enlighten you about different financial topics that affect my world and by design could affect your world. And one of the questions that we get asked frequently is, what is the difference between a mutual fund, an exchange-traded fund, and a hedge fund? So I want to take a few minutes to just kind of talk about what makes each of those unique. And let's start with mutual funds because they've been around since the 1930s. A mutual fund company actually puts together a portfolio of individual stocks and bonds. And what makes that particularly great for you and I as investors is they take a lot of the upfront work away from us. In other words, you could research all the companies on the New York Stock Exchange, but they have professional analysts and portfolio managers that do that for us. They put these portfolios together and they package them in a way that they say, okay, we're going to have a portfolio of blue chip stocks, and we're going to have another one of foreign stocks, and we're going to have one of bonds, and we're going to have one of real estate. And what it allows us to do is to have diversification and professional management, both things that have aided investors for years. So a mutual fund does just that, okay? The portfolio managers will manage the fund as they see best to try to maximize your rate of return. And they've been helping investors for basically almost 100 years. More recently, we've seen the introduction of what are called exchange-traded funds, or ETFs. And the name is a little bit misleading because they're not really funds. They're stocks. It is a stock that invests primarily in an index. So what is an index? The Standard & Poor's 500, the Russell 2000. These are indices of a basket of stocks. And so when they're investing in these indices, we get diversification because the index has anywhere between 300 and 500 stocks in it. But they don't require as much ongoing professional management, and as a consequence, the internal costs of an ETF are significantly lower than a mutual fund. And they can be a little more tax efficient if you own them outside of an IRA because they don't throw off the same level of capital gains and dividends that mutual funds do. In fact, the only time that you're probably going to have to pay tax on an exchange-traded fund is when you choose to sell your shares. So it gives you a little bit more control and it has more tax efficiency associated with it. Hedge funds are something completely different. Hedge funds came out basically in the 80s. And most of you will never own a hedge fund because the requirements to own a hedge fund are so strict. You have to typically have a net worth of more than $1 million and an income of more than $200,000. And that knocks most of us out in terms of qualifying for that. So why is a hedge fund important? Because for people that do qualify at those levels, putting money into a hedge fund allows you to have a portfolio manager that has great latitude. The portfolio manager will be constantly buying and selling, shorting positions, going long positions, using puts, using calls, using alternative strategies. Now, all those alternative strategies and all those puts and calls actually increase the costs. So the cost of a hedge fund is significantly higher than a mutual fund or an exchange-traded fund because there's much more activity. Now, does that activity necessarily translate into good performance? Of course not. In some cases it has, and in other cases it hasn't. The thing I want you to focus on is that if you never qualify to own a hedge fund, it is not going to have an impact on your ability to have a successful investing career and a successful retirement. So, just a little bit about 3 different ways that you can invest money. And if you do have questions about that, pick up the phone, call Renee, call me, ask questions, and we'd be happy to go through it for you. And again, thank you for your time, and I hope you learned something new on this video.